Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. We have moved on from the May contract, and today we want to take a look at the July corn futures contract. Today we find that the market has reached a very critical level at the 408 number. That 408 happens to be a point of control level, and given that we live at point of control, we can see where the market made its initial impulse coming in during the month of March, where we found very good correction after having hit one of our 2x1 natural angles. The market found resistance at that 2x1 angle on a number of occasions, finding support at our 1x1 on the way up, and then most recently we find a very nice top near that 408 number. The impulse move that the market made is the initial impulse that we want to consider in terms of major strength, showing very good strength as far as the oscillator is concerned. Since then, the market has dipped down to find some weakness across a sideways consolidation, and it's recently made a new high, but that new high was made on a bit of less strength. Although the strength that we're seeing is close to the previous momentum movement, it is possible that we can see corn returning to strength, especially if it's able to close above the 408 number. Currently, downside support that we're looking at sits at about 393. And below 393, we're looking at 389, which would be one standard deviation below the point of control. As long as this market does stay around the 395 number for the balance of the week, we believe that the potential for upside swing from these current numbers is still possible and for the corn complex to return to strength. Our next timeline that we're looking at is going to be sometime in early June, and so the way in which the market continues to trade over the next couple of weeks is going to be telltale. Part of why the recent top that we're seeing for this contract may have come in is a time factor that we had labeled for May 4th. You can see how nicely the market did come in conjunction with having hit one of the tangent functions of an arc swing, at which point we can see where time and price came together to pinpoint a very key strategic high for this contract. From here we can see down below that 393 number is a Fibonacci 38% retracement, and we're looking for very good support to potentially come in somewhere between 388 and 389. So we can see on both charts how they are complementary to one another, giving us some key levels where this market can trace. We do have an arc swing where the market comes in, and this could very well be where this market starts to make a little bit of a move to the downside, but upon hitting support, perhaps at one of our timing angles, we can see a reversal for the market to turn back up again. The way in which this market finishes out the week is going to be key and very telltale for us in terms of what goes on from here, given that the market would have had a bit of time to digest the recent WASDE report. The December contract paints a bit of a different picture, where we can see the momentum movement from the previous impulse move to the upside. We're looking at a market now that actually is making new highs on greater strength. So we're not seeing the divergence that exists in the December contract, suggesting that the deferred contract may be stronger than the front month contract. We can see where the market had a bit of a consolidation in between its move, but if you recall the movement from the July contract, we saw the market actually move sideways similar to this motion here, and then come in to make a marginal new high. Instead, what we're noticing with the December contract is the market's making higher highs and higher lows and remaining in a very strong channel in between a 2x1 and 1x1 angle. If this market then is able to finally break above our point of control number of 415, we would expect that the market could very well find continued strength and perhaps make its way up to about 440. Again, we want to see the way in which the market trades over the next couple of days in response to the recent USDA report. Interesting note for the December contract, you can see a very nice consolidation that has been occurring at our 180-degree mark of 419. We've talked about the importance of the 419 number for this December contract, and this level did not fail us in terms of showing us the level of importance for that area for this contract here. Upon being able to close above this 419 number can be telltale, and our next time factor that we're looking at for this contract is in about 2 weeks on May 25th. Unlike its corn counterpart, soybean has not been able to maintain its strength, And we've discussed before where the market started making lower highs, that if the market came in and made one more lower high below this 1396 number, this market could very well fail and give us a very accelerated move to the downside. Most recently, we found a bit of support at our 180-degree mark at 1014 3/4, and the market has been holding there for a bit, but we can see very clearly that this market has been in a declining phase and moving opposite to that of corn. Typically, corn and soybean will often move in concert with one another, but right now we're seeing that the markets are diverging. Given that divergence, we would simply allow them to play out before they converge and start to move together in a similar fashion. For now, we're seeing continued weakness for the soybean space, especially with ongoing negotiations still in play with regard to U.S. communications with exports to China. The momentum on the November contract has been particularly weak, as we've discussed in the past how the market has shown us very strong divergence with the momentum dying off. We anticipated that continued weakness was perhaps in the cards for the November contract. Additionally, we had spoken about the importance of being able to get through the 1052 quarter number. This has been a particularly challenging level for this contract, and as you can see, even as we tested this number again last week, we were not able to get a close above this number, and given its inability to clear this area, as anticipated, the market has since moved down. We're looking at a bit of support somewhere in the neighborhood of 1015, where the market has given us a bit of a bounce, but even given the move today, you can see a nice wide-ranging day, but the market gave up most of its move, closing at the bottom third of the day. If the next trading day shows us something similar to this in terms of a trading range, from which point we could very well see a very clean precipitous drop in the soybean complex, and perhaps one that traces down along our 2x1 angle. It's going to be critical to see the way in which we trade over the next couple of days, as the market sits up right up against key level of 1028. Being able to hold this number and perhaps get above our 1x1 angle would be most advantageous for the possibility of continued strength. For now, the key is going to be the way in which we trade tomorrow to see whether or not continued weakness is perhaps in the cards. Taking a look at volatility-based support and resistance, we can see where our 360-degree mark of 1050 coincided with the bottom end of volatility-based resistance. We anticipate potential support could come in at the top end range of volatility-based support. That number sits right at about 1008, and so we're looking to see if the market were to break, the line of the sand that we'd be looking for is whether or not it's able to hold somewhere in the neighborhood of 1008 to 1013. If it's not able to do so and breaks below and clears below the $10 mark, then we're looking at the possibility of continued weakness for the coming weeks. Wheat futures made it to our minimum price objective of about 525, rising up to one standard deviation above our point of control at 538.5. The market reached that number and has since been on the down, but we're looking at potential support sitting right at the $5 mark. It's going to be key then over the next couple of days to see whether or not the $5 mark can hold. If it holds $5, then the possibility of moving up one more time to test 560 to 570 is possible. But for now, the movements that we're seeing are consistent with some of our expectations. Key support needs to come in near that $5 mark once again to determine whether or not we're able to see upward momentum, and we do have a time factor coming in over the next couple of days. Oftentimes, we'll notice that previous highs can operate as future support. That's close to where we're sitting right now. So the next level that we'd be looking at in terms of a previous high sits at about 490. So at the very minimum, we'd like to see 490 hold if this market is able to make a run to the upside. But upon breaking 490, we think that continued weakness could very well be in the cards. Interestingly enough, the top that was made last week happened to lie right inside of the overlap of our volatility-based resistance bands. So upon making it up to that number, and we had an end band indicator post, that top end target was very much in line with where the market was going to find a bit of a pullback, or at the very least some profit taking. We also had a time factor come in for May 2nd, so there were several things operating suggesting that this market could very well move up and find a potential top coming in. Again, we're looking for support to come in if this market's able to make it higher. We're sitting right up against a 270-degree mark near that $5 mark that we discussed. So if the market's able to bounce up from this level, we can see one more advance that perhaps goes up to test the 180-degree mark near 560 or 570. In closing, we'll take a look at the US dollar. We can see that the dollar has been making a very nice move to the upside upon breaking the $91 mark that we discussed previously. It moved all the way up to 93.43, where it found some good resistance near our target of 93.56. We can see a bit of exhaustion coming in, and the market's perhaps taking a breather. And from here, this continuation pattern that we had seen developing suggests that if the market's able to break back above 93.56, that we could see a movement that would mirror the length that the market did coming into the move, suggesting that a move all the way up to about $95.85 to $96 is possible. The market again is finding some weakness today, but if it's able to return to strength prior to breaking below $92, then we think that an upside movement that does go up to test our 360-degree mark is possible. Over the next couple of days, we'll continue to monitor the way in which this market is moving. Right now, though, it is setting at a key level. We simply want to wait and see the way in which it pans out. From a weekly perspective, we can see that our volatility bands continue to point downward as the market has made its way to the upside, suggesting that a bit of exhaustion could very well set in. But all of that could mean that the market gives us a pullback and returns back to strength, given the strength upon which the market has come in here. But as we can see very clearly over the last 4 to 5 weeks, the market has had some very good strength with the exception of this week, though that is to be expected as all markets do not go straight up or straight down either. Key support then that we would be looking for would be at the $91 mark, having been previous support in the past. If that level once again becomes support, then we can see a dollar that could very well start to find its way back up again. On the flip side, if the market does find very good resistance here, breaks below the $91 mark, then we're looking at a market then that returns to the potential of weakness back below and then starts to make its way down to perhaps about $85. Thanks so much for joining us for our market update. Look forward to touching base with you again next time.